Welcome to NCOFCU's podcast. This is Kai and Emma, and today we want to talk about term deposits like share certificates and CDs, and why they're one of those rare topics where regulators and credit union boards end up agreeing, even if they describe it in totally different ways.
Regulators usually speak in the language of risk. Boards tend to speak in the language of strategy. But here's the funny thing. Whether you're coming at it from an examiner's desk or a boardroom agenda, term deposits often lead you to the same conclusion. They make the funding story more stable, more predictable, and easier to defend when conditions get choppy.
Let's start with a regulator perspective. Examiners like stability, and term deposits are built for that. Unlike regular shares or money market accounts, these funds don't typically move on a whim. They're locked in for a set period, and that means the maturity dates are known. When a regulator looks at liquidity risk, they're basically trying to answer one core question. If things get stressful, can this credit union get through it without scrambling for cash? A solid base of term deposits makes that yes feel a lot more believable.
Term deposits also help with interest rate risk management. When your funding has a defined term, you can line it up more intentionally with your assets. That improves asset liability matching and reduces the kind of repricing uncertainty that comes with non-maturity shares. The result is that key measures like NEV, NII, and stress testing outputs tend to behave in a more predictable way. Predictability matters, especially when you're trying to prove you can withstand rate shocks.
Another reason regulators tend to favor term deposits is the source of the funds. Member-sourced funding is generally seen as healthier and more durable than leaning too hard on wholesale options like FHLB advances or brokered funds. Term deposits can be a sign of organic strength. The credit union is attracting and keeping member money in a way that supports longer-term planning, not just plugging short-term gaps.
And when it comes to stress tests, term deposits often receive lower runoff assumptions than more liquid accounts. In plain terms, the models assume term deposits are less likely to disappear overnight, which can improve the credit union's projected survivability under stress. Put all that together and yes, the exam narrative often looks a lot calmer.
Now let's switch to the board perspective, because boards don't typically adopt products or pricing just to make examiners happy. Boards see term deposits through a strategic trade-off. They cost more than regular shares. Usually everyone in the room knows that. But what you're buying with that higher rate is certainty. So the real question at the board level becomes, are we willing to pay a little more for funding we can actually count on?
In a steady rate environment, that question can go either way. But in a volatile environment, when rates are moving, competitors are repricing, and member behavior can shift fast, many boards decide certainty is worth the cost. Term deposits add structure to the balance sheet. They can reduce the surprise factor.
Boards also tend to connect term deposits to growth. If you want to expand mortgages, deepen commercial lending, or ramp up indirect programs, you need to feel confident about the funding behind those longer-term assets. It's hard to grow responsibly when your funding could reprice instantly or walk out the door at the first sign of a better offer. Term deposits provide a layer of insulation when markets move quickly.
And experienced boards remember the moments that made liquidity feel real. Rate shocks, deposit outflows, and the consequences of relying too much on hot money. Term deposits don't eliminate risk, but they can reduce the odds that you're forced into reactive decisions at the worst possible time.
There's also a governance and credibility element here. A thoughtful term deposit mix tends to support a clean, understandable story. This is how we fund ourselves, this is how it matches what we're doing on the asset side, and this is how we stay resilient in different scenarios. When that story makes sense, exams tend to go smoother, and oversight looks more intentional.
So what's the takeaway? Regulators like term deposits because they reduce uncertainty and lower key risks. Boards like term deposits because they enable strategy with fewer unwanted surprises. The goal isn't to become overly dependent on them. It's to use them deliberately, as part of a balanced funding approach.
Thanks for listening. If you found this helpful, please subscribe for more episodes and share it with someone who could use it. For more educational resources, visit our website at www.ncofcu.org under the Education tab, the First Responder Credit Union Academy.
Be safe and keep moving forward.